Jeni Browne. Welcome to MFB News. Hope everybody is very, very good and you are absolutely capitalising on this incredible weather that we're having at the moment. Doesn't it make a difference to the mood? I mean, maybe it's just me, but I am the most miserable bag in the world when it's cold and wet. So I am absolutely loving this weather, albeit through an office window. Now, what we've got for you this week, we're going to be looking at what's been happening with swap rates, lender pricing changes, and also a couple of pieces of lending news. I want to say criteria changes, but that's not strictly true. So lending news. We're then going to be having a look at what's going on with the sales market, a quick update on the Renters' Rights Bill, and also we're going to be looking at why HMOs are definitely something worth reconsidering if you haven't done so already for your investment strategy. Okay, now just to quickly touch on inflation, because as I am recording this at 7 o'clock in the morning, the latest inflation news has just popped up on my BBC News feed, telling me that inflation has held at 3.4%. So essentially, in May, it was the same as it was in April, so no change there. So let's see how the markets react to that in terms of swap rates when we catch up next week. I don't think that's particularly positive news, if I'm honest. I'm not sure the markets had expected inflation to be at 3.4%. Well, we know they hadn't expected to be at 3.4% last month. The fact it's stuck there probably won't be the greatest news. Now, in terms of swap rates, however, on a slightly more positive note, what's been going on with those guys? So as of last night, 2-year swaps were at 3.68. 1 month ago, 3.78, and 1 year ago, 4.8. So actually, even month on month, we're in a slightly better place now, which is a nice position to be in. And similar news on your 5-year swaps as well. So as of last night, 5-year swaps were at 3.68. 1 month ago, 3.78, and 1 year ago, they were at 3.91. So the year-on-year reduction on 5 years versus 2 isn't quite as exciting, but actually still things have come down slightly. So in terms of where that leaves us, so swap rates are circa 0.1% cheaper than they were, say, 1 week ago on 5-year money and also 2-year money. So what this really does is, I guess, leave the door open for lenders to make some very small pricing adjustments. So I don't think any of us would be, able to say that actually 0.1% lower on a mortgage interest rate is going to sort of change our lives. But actually, at least it's tracking in the right direction downwards, at least for now. Okay, so a quick look at who's been doing what with the lenders and their mortgage rates. It's been a very, very quiet week actually again. And because there hasn't been much change in the lenders' cost of funds and the reduction in swap rates down by the 0.1% I just mentioned has only happened in the last few days. And these things don't sort of kind of kick in overnight. Changing product sets takes time for lenders. For most of them, some of them can be pretty agile, but most of it takes a while to catch up. So what have we seen? So we've seen Keystone reduce their rates by 0.1%. Keystone are a specialist lender. They're incredible, actually. They're all kind of like old school in the way they underwrite. So it's all about making sure that, the decision makes good risk sense rather than kind of just letting a computer make the decision for you. So you won't be surprised to hear on that basis they're able to lend to individuals with large portfolios, limited companies, also large portfolios there. HMOs, multi-units, day one remortgages. They're good on people with a sort of, a blemish on their credit file. So not a kind of really, really terrible credit score, but actually if you've got a little missed payment a couple of years ago, they're going to ignore it. So loads of good stuff in their criteria. Really good to see these guys bring their rates down, albeit, by 0.1%. On that note, we've also seen Together bring their rates down, but up to 0.65%. Now, Together are a very, very specialist lender. There isn't really many people who couldn't get a mortgage with Together. They're kind of, I don't want to say they're a lender of last chance because that's really unfair on the really great stuff that they do. But their pricing is very, very expensive because they are very open to considering pretty much anything. So when I say their rates have come down by up to 0.65%, that doesn't mean that suddenly they're charging, 3%. The rates are still really high and they had a lot of room to bring their rates down. So good to see them making a reduction. Very, very specialist lender. Not someone we talk about often at MFB News because they really are very, in my mind, they're quite niche. The times that we use them the most, they're very good at bridging finance. They're good at land loans. So if you found a piece of land that you want to buy, which has no planning permission. You've got no real kind of immediate ability to develop it. So you're buying the land speculatively to develop in the future, or you just want to own a bit of land is the other thing. These are one of the only lenders who can actually help with that. So they've got some really good strings to their bow, but certainly not a kind of day-to-day buy-to-let lender. Now, we've also seen a couple of lenders put their rates up. So Land Bay have increased some of their rates by 0.1%, and Paragon have done exactly the same thing. So what we're seeing here is just tweaking of rates because of the way the swap rates have been moving around, but nothing to kind of be alarmed about. I would say I'm not expecting a whole wave of lenders to suddenly stick their rates up in the next week, but obviously we'll keep you posted. Okay, now as I mentioned earlier, we've got some lender news, and we're going to go into commercial for a moment. It's not something we talk about often. We do commercial mortgages at MFB. We do a lot of commercial mortgages at MFB. We're very good at them, and also semi-commercial. The reason I think this is interesting is because the lender who has just come into the commercial space is lending in areas of business which often a lot of lenders shy away from at the moment. So welcome to the commercial sector, MT Finance. MT Finance were originally a bridging lender, now they're a bridging and buy-to-let lender, and now they also offer commercial as well. So they kind of really rounded off their offering to suit all types of investment asset classes. So MT as a buy-to-let lender is very, very good. We really enjoy working with them. A bit like Keystone, it's kind of more traditional underwriting. They're able to kind of take time to really understand the bones of the deal, really understand the borrower's profile, and decide whether commercially they think it's wise to lend that person rather than just sort of it being a tick box exercise, which we really, really love. Now, on the commercial offering, what they're saying, and these are their kind of key USPs. So minimum loan size is £100,000. They can lend up to 2.5 million. The loan term can be from 5 to 30 years. Up to 75% loan to value on standard property, 70% on specialist. You can do interest only or capital repayment, and they're able to lend to individuals, limited companies, LLPs, and also expats. Now, the minimum income the property needs to be generating is £15,000 per year, which actually, when you look at the minimum loan size, all kind of ties in. And they're looking at offering mortgages on a wide range of properties. They're saying from offices and retail units to care homes and hospitality. And it's that last one, hospitality, which I find particularly interesting because that is certainly a sector which a lot of lenders are shying away from. If you think about things like pubs, which are really struggling, we know the number of pubs closing down every year is absolutely huge, very, very sad, by the way, every year, then actually it's fantastic that MT is saying we're going to support this particular industry. So very good news there. They're also able to accept new build commercial properties as well. So to my mind, the reason this would be interesting to you is if you're looking at buy-to-let, you're thinking, you know what, actually it's a bit of an arduous at the moment. I'm thinking about investing. I'm looking at different asset classes. Commercial is worth looking into. We'll do a kind of blog. There's loads of information on the website which talks to you about the benefits of investing in commercial property. And actually it's really great to see just another lender recognise that this is going to be a growing part, and it is a growing part of the market for sure. There are more landlords diversifying into this at the moment. Now, the other piece of news which I just want to share with you is that our friends at YBS have changed their HMO criteria. So YBS are the commercial lending arm of part of the Yorkshire Building Society. They also have a more vanilla buy-to-let arm, which is the McCord Mortgages brand as well. So what they've done is they've been looking at their HMO criteria and they have made some adjustments. So first of all, they increased their maximum loan to value to 75%. It was 65%. For HMOs of up to 6 bedrooms, they'll lend based on the property's market value or vacant possession value, whichever is lower. They have also said that actually for HMOs with more than 7 bedrooms, their maximum loan to value is now 70%. Landlords can now borrow up to £3 million. It was previously 1.5 million. And the maximum number of rooms available in an HMO is 20. It was previously 12. Finally, they've increased the maximum exposure a customer can hold with them, securing HMOs to £10 million, was previously £5 million. So what we're seeing here is that essentially YBS are kind of really broadening their criteria to make themselves able to help more landlords, which obviously we're going to really, really appreciate. YBS is a lender. It's a commercial lender who does kind of residential investment property, very good at kind of more quirky company structures, let's say. Don't mind landlords with loads of properties in the background, able to lend on larger ticket deals essentially. So great to see these guys make some criteria and amend their HMO criteria to align with the market. Okay, now a quick look at what's going on with the property market in terms of selling and buying, because this is quite useful statistics, particularly if you're thinking about buying, but also if you're thinking about selling. This might kind of lead you down a certain path, and particularly for those landlords who are thinking about selling off some buy-to-lets. This will kind of give you a view about how potentially easy it's going to be for you to sell. So, first of all, listings are 6% higher than the 2024 number and 8% higher than the pre-pandemic market. So essentially, lots and lots of properties available for sale. There were 27,900 price reductions, so 14% were reduced last month, compared to 12.1% last year and the 5-year average of 10.6%. So essentially, we're seeing more properties for sale and more people having to reduce the asking price on their properties. So currently there are 32% more price reductions than the 5-year average. 28,600 homes have been sold subject to contract. Subject to contracts are up by 8% year on year. So we went into June with 756,675 homes on the market. As the market gets stickier before the pandemic, that number was circa 660,000. If you're looking for what a number would be in terms of homes for sale to make it a seller's market rather than the buyer's market, it needs to be sitting at around 600,000. So as you can see, we're running very, very hot on homes for sale, hence we're having to see things reduced. And the reason this is important is that if you are thinking about selling at the moment, you may be lucky, you might put your property on the market and it might just sell really, really instantly. But the reality is that it's actually quite hard to sell properties at the moment. Now, the good news is that fall-throughs are staying below the 7-year average at 23.5%. All relatively normal noise. The net sales are still playing balls, 6% up on last year and 11.2% higher than the 2017 to 19 average, not quite at the 22 levels, but the stamp duty cliff edge would have forced a few more transactions out of bed. So there you go. The housing market or the property market is pretty good if you're looking to buy. Actually, it looks like prices are kind of being negotiated quite aggressively. People are reducing things. Were they starting at unrealistic high base to begin with? Who knows? But the reality is that actually house prices are very much up for negotiation. Not so good if you are thinking about selling. Okay, there's Renters' Rights Bill, just an update for you on what's happening there. So the Renters' Rights Bill is going to reach its crucial report stage and third reading in the House of Lords on the 1st of July. So this is the date you kind of want to be aware of. So the 1st of July is when we get the report stage and third reading. Now, some people are saying this is paving the way for it to return to the House of Commons, and because there is such broad cross-party support for the bill and few major disagreements between MPs and peers, some are expecting the bill to receive royal assent and essentially become law before the Parliament's summer recess on the 22nd of July. However, others are thinking this is unlikely, and because there are 2 more stages to go through before we can get to royal assent, so people are looking at the autumn. So depending on who you're listening to, we're still not entirely sure when this is going to happen. Now, even after it becomes law, we're going to need to see the timetable for enactment to see when things are going to start impacting landlords. So just because it comes law, it doesn't mean it all kind of starts immediately. There's going to be running periods for each particular part. Now, you lot, what has surprised me somewhat is the number of people who are actually, I'm going to say, not aware of the Renters' Rights Bill. So I've got clients who have really sort of sizable portfolios and they have got no kind of, I don't want to say no idea about it, they just haven't looked into it. So I'm not sure people are necessarily so aware of the impact the Renters' Rights Bill might have on them. Not all of you, obviously, but some of you. So I just want to kind of run through the key things in the Renters' Rights Bill, really to kind of demonstrate why it's important to understand. So first of all, there's going to be the abolition of Section 21 on no-fault evictions. There's going to be periodic tenancies for absolutely everybody. There's going to be tighter controls on rent increases. There's going to be a ban on bidding wars. There's going to be something called the Decent Home Standard brought in. There's going to be an extension of AWAB's law, which means that it's going to affect the private rental sector as well as social housing. There's going to be a new private rental sector ombudsman, and it's going to be essential for landlords to kind of appear on a landlord and property database. There's also going to be anti-discrimination protections. This is that landlords' agents cannot discriminate against tenants who are either on benefits or who have children, and also tenants are going to have pet ownership rights in terms of keeping pets in rental properties. So if you are one of those landlords who's kind of just ignoring it for the time being, probably worth having a look, because ultimately the Renters' Rights Bill is going to impact all of us. So we just need to make sure we are across it. If you want information, there is absolutely loads of it on our website. So go and have a little nosy around on there. You'll find lots of information which should be quite informative. Sorry, that really threw me. As I was recording this video, the biggest hornet just suddenly appeared from down my chimney and just flew across the room. Summertime, and having your windows open, your house exposed to the elements. Anyway, we're just going to finally just wrap up by having a quick chat about HMOs. So a new analysis of student renting suggests that houses in multiple occupation demonstrate particularly robust fundamentals. So data from portal StuRents shows that some 77% of British students choose HMO accommodation over purpose-built student accommodation, with HMO sector achieving rental growth of 5%. It's benefited from the addition of 160,000 UK undergraduates since 2016, creating a substantial and growing domestic market. So with HMOs showing consistent upward trends and the sector offering stronger rental growth prospects. The StuRents data reveals that domestic demand drivers are strong, with positive long-term demographic trends supporting continued demand, while additional affordable supply remains constrained. So there you go. If you are thinking about investing, not entirely sure what to do next, student HMOs could be a really, really good offering for you. We have loads of clients who absolutely love letting to students. They think it's absolutely fantastic. So there could be a really good opportunity for you there. And that's me for this week, wrapping this video up really, really quickly because I'm slightly concerned about where that massive hornet's gone and whether it's going to come out and attack me. So have a fantastic week. Enjoy the weather. If you have any questions, do get in touch. 0345 345 6788. And just as a kind of side note, I had a chat with one of or a couple of our viewers of this video. Thank you so much for getting in touch. It was really lovely to speak to you both, and they gave me some really interesting feedback in terms of things on this video that they have particularly enjoyed and found useful. So we're going to kind of work with our marketing team to try and bring more of that kind of stuff to you guys. But if any of you else have any questions or things you'd like us to introduce, what you do like, what you don't like, feel free to leave a comment in the video below, or you can just reach out and email us, inquiry@mortgagefinancebrokers.co.uk. Have a super week. I'll see you next time.